The hotel industry has been undergoing a massive transformation for the last couple of decades. These are three of the largest hotel chains in the US. As of 2023, these three brands accounted for over 17,000 hotels worldwide, with Marriott being the largest. But despite the fact that these properties operate under these brands, the overwhelming majority of these properties are not actually owned by them. In fact, Marriott and Hilton own less than 1% of their properties, whereas Hyatt owns around 2%. The majority of these properties are owned by third-party companies that pay these brands to use their name. This transformation is a result of a decades-long shift that has enabled hotel chains to expand faster, reduce risk, and improve their performance. Let's dive into more detail. Historically, hotel brands operated using a fairly simple business model. If a company like Marriott wanted to grow its portfolio of rooms, it would either build a hotel from the ground up or purchase an existing property from another brand. Under this model, hotel companies not only managed and operated their properties, but also owned them outright. Full ownership gave brands complete control over the design, maintenance, and operation of their properties, allowing them to deliver a uniform experience across locations. Ownership also meant that hotel companies could benefit from all the revenue streams generated by a property, including room bookings, event space rentals, dining services, and other amenities. Beyond operational benefits, owning real estate also provided financial advantages. These properties often appreciated in value over time, offering hotel brands a stable asset base. But major hotel brands like Marriott, Hyatt, and Hilton have slowly moved away from this model and have implemented something called asset-light. The asset-light strategy is a business model where hotel companies focus on separating the ownership of real estate from the management of operations. In this model, hotel companies collaborate with third-party property owners or investors. These owners are responsible for building and maintaining the physical properties, whereas hotel companies provide the expertise and systems needed to operate these hotels. This collaboration is typically formalized through management contracts, franchise agreements, or license agreements. For example, a hotel chain like Marriott might manage a property owned by an investment fund. The investment fund pays for the construction and upkeep of the hotel, whereas Marriott operates the property under one of its brands, such as Sheraton or Courtyard, and earns a management fee. This approach allows hotel brands to focus on what they're best at, providing excellent guest experiences and building brand value. Meanwhile, property owners concentrate on the real estate side. This business model offers several advantages, and one of the most important advantages is the fact that this approach is much easier on the company's balance sheet, meaning that the capital investment required is much lower. See, building and owning hotels requires a massive amount of capital. A luxury hotel in a major city can cost hundreds of millions of dollars to develop. By adopting an asset-light model, hotel companies avoid these upfront costs. For example, instead of spending $200 million to build a single property, a hotel brand can use that capital to expand its marketing effort and sign contracts with 10 property owners in different locations. This makes it much easier for these companies to expand. Take a look at Marriott, the company that practically started this move toward asset-light in the 1990s. As of 2023, the company had 8,785 hotels worldwide, more than double the number of hotels it had in 2009. According to Marriott's CFO, the company's hotel system is made up of over $500 billion worth of real estate, and it would be impossible for Marriott to replicate this if they had to invest their own money to build and develop these properties. Furthermore, this has also helped Marriott expand its presence internationally. Around 30 years ago, Marriott had very few international hotels. This was due to the fact that it was expensive and quite risky to buy land in a foreign country, build a hotel there, and navigate its economic and political environment. However, now around 40% of the company's hotels are outside of the US. According to the company, this is because by partnering with local investors who understand the market, Marriott has mitigated these risks, which has allowed it to supercharge its international growth. Following an asset-light strategy also helps hotel brands improve their financial performance by boosting their profitability and cash flow metrics. The simple math is that the more earnings that an asset-light hotel company has, the higher its actual cash flow by virtue of the fact that its capital requirements for reinvesting in real estate go down. So, a bigger management franchise base and a smaller owned hotel base means a higher translation of earnings into cash flow. This financial flexibility allows for strategic investments, debt reduction, and shareholder returns. Finally, an asset-light strategy also shifts the risk of owning a hotel to the operators. Market fluctuations can lead to operational losses. For example, if a global economic downturn causes a drop in travel demand, hotel properties may struggle to stay profitable. When hotel companies do not own the real estate, they are insulated from these risks. If a hotel underperforms, the property owner bears most of the financial burden. The hotel company still earns its management of franchise fees even if the property struggles. Take the COVID-19 pandemic. During this time, the global hospitality industry faced massive challenges due to the fact that travel was severely limited. Many hotels were reporting losses due to the fact that demand was nowhere near where it's supposed to be. However, companies like Marriott, Hilton, and Hyatt were less affected because they had fewer fixed costs tied to property ownership. The asset-light strategy has also fundamentally shifted the goals of hotel brands and has changed their business model. Historically, hotels aimed to maximize room occupancy and revenue per available room. Success depended on how effectively they could attract and retain guests. But today, things are different. This is Marriott's income statement for 2023. Take a look at the revenue segment. As you can see, Marriott reports 5 main revenue streams: base management fees, franchise fees, incentive management fees, owned, leased and other revenue, and cost reimbursement revenue. In fact, it's actually 4 because the cost reimbursement revenue does not really count because it reflects amounts Marriott received from property owners to cover expenses incurred while managing their hotels. Although this is a large revenue stream, it is typically offset by a corresponding cost, usually called cost reimbursement expenses, and does not significantly contribute to Marriott's profitability. As we can see, in 2023, Marriott brought in approximately $4.82 billion in fees, whereas revenue from the properties Marriott directly owns or leases accounted for only $1.55 billion. So, around 75% of the company's revenue come from fees it charges operators for using the brand and its services. This means that the business model has changed to the point that hotel brands like Marriott, Hyatt, and Hilton now compete for operators instead of for travelers, which means that these companies have to constantly make it attractive for operators to sign up with their brands. One of the biggest advantages to flying a flag, a saying that refers to operating under the brand name or franchise of a hotel chain, is the strong brand recognition. Marriott, Hyatt, and Hilton are some of the most recognizable hotel brands in the world, and flying their flag can increase their customer trust and drive higher occupancy rates for operators. Additionally, the brands offer expertise in hotel management, including staff training, marketing strategies, and revenue management. They also provide revenue managers that take into account what's going on in that marketplace and calculate room rates to optimize for the hotel's profitability. For example, say there is a concert coming next Tuesday to a smaller city. Hotels do not want to sell out their rooms just for that Tuesday because that leaves them exposed on other days. So what they do is they price the Tuesday rate at an extraordinarily high price for those people looking to book a room only for Tuesday. This way, they incentivize people to book Monday to Wednesday or Tuesday to Thursday, making up for less profitable days. Flying a flag can also help owners target wider pools of hotel customers with better fees for booking platforms like Expedia and Booking.com. Another massive benefit are the loyalty programs. See, all these 3 hotel brands have their loyalty programs. Marriott and Hilton have over 180 million members each, while Hyatt is smaller at over 40 million members. These numbers represent a massive network of potential repeat customers. For operators, this means tapping into a pre-existing audience. Guests are incentivized to choose a hotel within the brand because they earn points they can later redeem elsewhere. This creates a self-reinforcing loop, where staying at one brand property feeds into the desire to stay at another. This becomes especially impactful in secondary and tertiary markets. Without a brand's flag, hotels in these markets might struggle to attract enough guests to stay profitable. But loyalty programs change the game. Travelers are drawn to these hotels not just because of convenience, but because they see an opportunity to earn points they can later use in more attractive destinations like Miami or New York. In essence, loyalty programs, combined with the strength of a recognizable brand, turn what might otherwise be a risky venture into a sustainable and competitive operation for hotel owners.